Good evening, ladies and gentlemen, and welcome to the Stock Market Brief Show. On June 26, we made a video called The Great Stall of 2024, meaning that the market could probably stall out from around this point. We were seeing many factors to lead us to believe that the market could see some turbulence, could see somewhat of a stall out. And you can see the market went up a little bit higher. We got our big volatility event, and now the market's been coming back. Which brings me to today's video title, and that is The Great Shakeout of 2024. I think there's a lot of aspects in this market that are building. There's a lot of pressure that is building in these markets, looking for a potential move to shake out some people. It doesn't mean it's the end-all, be-all, but it does seem like the market's getting prime for a potential shakeout. So that's what we're going to talk about on today's Stock Market Brief Show, where we navigate the financial markets through the lens of technical and intermarket analysis. If you haven't done so already, be greatly appreciated if you sponsor today's episode by hitting that thumbs up. And that is indeed a thumb. Let's get into today's show. All right, ladies and gentlemen, welcome back to the show. We're taking a look over here at the 11 sectors that make up the S&P 500, some index products over here. See, everything was basically in the red other than three different sectors. We had consumer staples, healthcare, real estate. So we had, rate sensitive, and we had some, more risk off type sectors. And then energy took a pounding on the chin. We'll follow back up on the energy sector a little bit later. But overall, this was our first day down after this pretty monster rally that we've been seeing. The advanced decline line was rather mixed. We saw about a 50-50 over here in the S&P 100. Saw some strength, saw some weakness. And you can see the market just, this is basically a nothing burger of a day. Wouldn't read too much into it, to be quite honest. You can see that also in the volume. Now, what I can say about a potential shakeout is, remember, stocks, assets, they move between periods of expansion and contraction. And this has been an expansionary move, not only to the downside here, but to the upside. It's been a rather very volatile one-way ticket up, a rip-your-face-off rally. But now, as the price action has been moving up, we've been seeing pockets of strength on some follow-through days. That is a good sign. But now volume is really starting to dry up here as we're heading into some big events. And as volume dries up, it's going to be important to really see how this plays out when we see a volume expansion, right? So we see this strong, straight, very, very, straight trend line. Are we going to see a potential down day with higher than normal volume, creating what's known as a distribution day? And that right there could set up for a potential shakeout. And if you're not familiar or know of some key levels to watch out for, if the market is going to take a strong pullback, you can catch yourself flat-footed if it is only just a quick shakeout back to continue this all-time high bull market. Because remember, there's a saying, bull markets, they climb walls of worry. There's a lot of things that are going on in these markets that you can potentially worry about, but there's also a lot of good things, mainly price action, which has been pretty decent. So volume drying up, price action going parabolic, basically in a very tight wedge pattern, I would consider this. And now we're heading into some big macroeconomic data. And a lot of it's not just regularly on the calendar, right? So you have FOMC minutes tomorrow. I'm sure that's going to bring in some volatility. You have a 20-year bond auction right over there. Something that's not on there specifically is we do have a preliminary benchmark or revisions to establishment survey data. And this is coming out at 10 a.m. Eastern Standard Time. And there has been some notes about this. Crosby said that should the report reveal a considerably small number of jobs that were created than were initially announced in payroll reports, the Fed chair's concerns could be amplified in his comments when it comes time for the Jackson Hole Symposium. The U.S. stock market earlier this month went through a brutal sell-off in the wake of the disappointing jobs report. It did to an extent, but there was also that whole yen carry trade unwind. So it's going to be important to see how this report comes out. Now, that's not the only thing that's big going on too, right? We also have some big earnings from big retailers such as Target, Macy's, TJX. So this is going to really give us an inside look to how the consumers are doing from more of a discount retailer store like TJX, and then also a little bit higher end like Target, right? Walmart came out and the market loved what Walmart came out and did. So perhaps something like TJ Maxx can really look good coming into tomorrow. But we'll see, right? It's a binary event. We'll see how the market digests that information. Let's add to that. We also have a VIX expiration, right? When we have these expirations or OPEX days, tomorrow is August 21st. you could typically see much more volatility, whipsaws, and price action. So this is going to be moving out of the way. It's going to be interesting to see how things set up after that point. Okay. With all that said, too, if you take a look at the 10-year, 2-year yield curve, right, it started to be getting steeper and steeper over here, trying to move into that uninverted territory. But you can see since that point, it backed off a little bit. I do find it interesting down here is the 10-year, 3-month, and this one hasn't really steepened at all. But if the Fed is going to be cutting rates like it's pricing in here in September, it's likely to see this 3-month drop because it does track the federal funds rate very, very tightly. Now, when the Fed does start to cut rates and the yield curve uninvert, you can go back through history here, right? It did lead to stock market volatility. So as the market really wants the Fed to start cutting rates, it's also got the people got to understand that they'd be cutting rates because they see signs of the economy slowing down. And if it all of a sudden starts to pick up pace of a slowdown, it could present itself in a manner where we see much more volatility or even potentially crest into a recession, which would bring all kinds of recession fears, etc. Now, as this is taking place, we do have a dollar that, this is interesting to me how significant the sell-off in the dollar has been in recent trade. Today, we approached the closing price of the last year as dollar, and these can act as potential levels of support, these zones in here. And I think that's important to note because if the dollar does start to find strength or bounce up, that could, from a correlation standpoint, put pressure on various other assets. Like if you do look at gold, gold does have a negative correlation to the dollar from a both 15-day, 30-day period. And you can see it's deep, it's pretty darn well correlated negatively, right? You have, minus 0.76 over here, minus 0.89 on the 30-day. And that means if the dollar does start bouncing, it's likely to potentially see gold start to consolidate its recent breakout. And to add on to all of this, gold's been incredibly strong here too, which has also been one of those warning signs that we've been, like, what's going on here? The S&P 500 correlation to the dollar has typically stayed into a negative territory, but right now there's really not a correlation. And that makes sense because we've been seeing the S&P 500 rise and the dollar kind of fall and kind of sputter around. And you can see right here, the correlation's been going into negative territory and it recently just dived into negative territory. So perhaps that if the dollar does bounce, this puts pressure on the S&P 500 to consolidate, to slightly pull back this move. And this comes back into its deeper negative correlation. As you can see on many time frames, including the 90, it's been starting to move back into negative territory. The 120 starting to move back in negative territory. And then obviously the longer time frame, there's not much of a negative correlation, but you can see 180 days, it's been in that negative territory. If you also take a look here of the USDJPY, the Japanese yen, this is the talks about the whole yen carry trade unwind and how it's put pressure on the markets. And well, guess what? The yen is starting to gain strength here as the dollar has been falling off. And if you just look at Japanese yen futures, the last time we talked about it was, I think, on this day where we said, you don't even need to know what this product is, but it looks like it's just consolidating. It looks like it can get set up for another pop. And we're kind of seeing that move here, which can spark potential fears into some minds because, the correlation when the yen carry trade kind of unwound, you can see that the NASDAQ really broke down strongly with it. And since the USDJPY, right, started to move higher, the NASDAQ started to move higher. But what we're seeing here is strength back into the JPY, and you're not seeing any sort of reaction currently from the NASDAQ 100. Now, correlations, they come and they go. I'm just pointing this out because of its recent correlation on that volatility. So I want that just to be, perfectly clear. Now, here's oil, and oil is still in this really strong compression pattern, and it's been kind of coming off here. And you got to understand, typically falling oil prices, it's typically good for consumers, right? It means that, for example, transportations, right? So companies that transport, airliners, whatever the case may be, ship, freight, whatever, typically their big overhead would be oil prices. And if that comes down, that could relate to lower price goods for the consumer, could be lower prices at the pump. So overall, that's a pretty decent thing. But you also have to understand that oil prices, when they crash, it could also be because there's fears of an economic recession. We saw that happen, I believe it was in 2020, right, where we saw oil prices, what was it? They went negative or something, all that crazy stuff that happened. And we did go into a recession then during that whole pandemic. Now, as it states right here, right, in technical analysis, things move between expansion and contraction. You're seeing a series of lower highs, higher lows. Price action is getting coiled up here, right? So if this breaks, it could establish a new trend because the trend currently is rather neutral. It's kind of sideways to choppy. And if that new trend does establish in the downward direction, maybe that does spark more economic fears. You can also see that the oil, right, black line, and then the 10-year yield is the candlestick chart. They do move closely hand in hand, and a falling yield. So let's say a rising yield, and the reason why I'm pointing this out is because if oil does fall down, maybe the 10-year yield continues to track this, but a rising yield typically indicates falling demand for treasury bonds, and investors typically go to see higher risk investments like more growthier names. But on the flip side to that, falling yields obviously are the opposite. It could be a potential more flight to safety, or they see growth concerns. And what we're seeing here as the yields coming off, you can see obviously the 10-year, the TLT is starting to pick up pace, and we saw a massive move from the whole yen carry trade unwind, from the jobs report, whatever the case may be. Price pulled back, and we're starting to see it bounce and recover here. So if price wants to consolidate in these areas, it might be setting up another base for another move higher, and maybe considered another flight to safety, similar to what the dollar typically is, right? The dollar can act as a flight to safety too. So these are just various things that are taking place in the market. We're seeing bond volatility pick up. It's just a really time to be cautious here, but still have exposure. So it's a very confusing time, to say the least. And I'll get a little bit more into detail momentarily. This is the chart of the S&P 500. You're seeing that big rally back. And over here, highlighted in green, was when we had the 10 days of up price action. We had a 10-day winning streak. I think here we had 8. On the SPY, it was 10 days. On the SPX, I'm not too sure. But we had a 9-day to 10-day winning streak there in the SPX. And it reminded me, it made me think, like, when's the last time this took place? And I did the research, and it was back in 2010. You may have watched this video or saw my tweet about it. So I was like, okay, what was price doing after that area? Well, and it happened to be around in that March area too, right? This was happening in May. It was pretty close. And we started to see the price action continue to go up. And what did we see here? We saw price action continue to go up. And it wasn't to say the analog is going to play out the same way, but I did find it interesting and had to pull it back up because we saw this explosive breakdown here in 2010. And if it was going to continue to track, maybe we'd see that same type of thing. And well, guess what? We saw an explosive breakdown. And the reason why I'm pointing this out now more specifically, it has nothing to do with the economic time in 2010. It has nothing to do with what's going on now. It has to do with just how price responds in moments of panic and even potentially bear markets. This is normal in higher times of volatility to see moves down and strong moves back up. For example, in 2010, we saw that, rapid move to the downside there in May. What happened? The price action came basically all the way back near all-time highs again, and you can see that it got faded. So during this time, which is, obviously looks different on our current candle, people were probably saying, okay, everything's totally fine. And then all of a sudden you get hit down, it sparks even more fears, right? And then it came back up again. Oh, okay, no, we're coming. Understand, and this was probably right around the bottom before price action started moving up significantly more. The reason why I'm pointing this out now is because we have not seen price action get tested at all yet. It's been one-way ticket up. Today was a nothing burger day. Wouldn't read into it at all, other than volume dried up, and that's going to tell us that volume is going to be picking up here very soon. Could be tomorrow, could be this week, could be potentially next week. But to see some sort of a pullback or consolidation would make a lot of sense. Now we're going to get a little bit more specific as to where, if we do get some, strong moves to the downside, where can we be prepared for a bounce? And I think that that's most important because we already been prepared after our follow-through day on how to get more exposure into the markets. We've said that. We did that all the way back there. We were ready, okay? And if you're not ready and we're going to see another hit down, we're now going to prepare for something like that and or consolidation, okay? So first and foremost, when I pull up the daily chart of the SPY, I want to just point out the month-to-day anchored volume-weighted average price and the swing low anchored volume-weighted average price. You can see price actually went straight up and we haven't seen it consolidate. A flag out would be perfect, right? But if we do see more volatility, I'd be paying very close attention to these lower levels here, roughly at about 530, 535. slightly above 530 here on the SPY. But these levels, these anchor volume weighted average prices, can act as potential areas of support. At least there'd be ideal levels to watch out for to see how price responds. Remember, you don't just buy when it crushes. If it were to crush right through these levels, you want to see strength pick up shortly thereafter and buy into this strength. Not to say that it's going to even hit these levels, but that's what we're kind of pointing out. Okay. Also to note, we're still in positive gamma territory. So even a move down, remember, dealers are going to look to buy the dip, sell the rip, buy the dip, sell the rip. And you can see once we got into positive gamma territory, this is when volatility started going down, right? Significantly more. And to be quite honest, I mean, volatility still seems rather high, even though that volatility index products, right, have came off. Now, going into tomorrow's trading session, it looks like we have some interesting levels at 55.75, and there are traders still reaching out further. We got 56.50 on deck, and 5600 was a zero-date level today, as well as 56.25, and you can see that price kind of really just posted in and around those current levels. If I look at the 15-minute time frame for this SPY, we're above a rising 5-day moving average. So if we do get hit, that would put us obviously under the 5-day moving average. The lower weekly expected move is over a 546.72. The upper weekly is 561. So not to say that we're going to get down here this week, next week. I don't really know if that's even going to happen. But if we were, this right here is that month-to-day anchored volume weighted average price, the swing low anchored volume weighted average price. It's right down there. You can see around that 530, 535 level. So if price were to come down into these ranges and the 5-day starts turning back around, you can see how price could potentially build a series of higher lows and see if it starts to recover to feel more confident if you did miss this particular run. Now, if that's not the case, I'm still saying that I still have exposure into these markets. I would be looking for consolidation, something on the lines of this or something on the lines of this, something to consolidate its recent run up and then start to see things tighten up again to play even more opportunities to the upside. It's all about managing risk, taking things slowly, right? If you're feeling the FOMO here because you missed it, or maybe you're overly excited because you actually got caught up in all of this and price action is coming back, you got to just be patient in these specific times, because as we pointed out just a little bit ago, there are still a lot of warning signs. The market hasn't been tested, and there's also a lot of good things taking place, right? So once again, just got to be cautious. Let's see how the data comes out. We have a lot of stuff taking place tomorrow, and I'm sure that we'll get, continue to put these episodes out. And as we get more data and more clarity, we'll do that. Now, another thing, if you aren't part of the Patreon, whether you're paid or a free member, I do midday updates every once in a while. And the last midday update I did, I went over probably about 10 to 15 different stocks, and a lot of them I currently have positions in. So if you haven't watched that, you can go look at specifically the individual names that I have been trading. Whether you don't need to join for the $9 a month to see that specific episode. I did it if you're just a free member. If you want to join, you can do it annually or pay $9 a month. If you join annually, you save quite a bit. It ends up being like $90 for the whole year, and you get a whole host of stuff in the Discord. That's all I got for you. See you later.